I'm here today to talk about China and China's multiple local problems and their global consequences. So right now, China is experiencing several headwinds for economic growth. And the first of these headwinds that I want to discuss is the pandemic, or perhaps more specifically, how China has decided to deal with the pandemic. So China has continued to enforce its zero COVID policy, and you could argue that this policy is the opposite of the strategy that many countries has opted for this year, namely living with the virus. Because the zero COVID policy, instead, that means that as soon as a couple of cases are discovered in an area, you have mass testing, you have contact tracing, big quarantines, and also big lockdowns covering large geographical areas. Then these lockdowns are eased as soon as no new cases are found and normal social and economic activity can resume. So, of course, for China, this has been very effective when it comes to limiting the spread of the coronavirus, but it has come at a very big economic cost. So in this graph here, we see that during the spring, China experienced its worst coronavirus wave since the start of the pandemic, following many outbreaks of this Omicron variant, the more infectious COVID-19 variant. And at most, the number of daily new cases reached almost 30,000 per day. And many of these cases were also discovered in key economic cities in China, like Shenzhen, the capital Beijing, but also perhaps most severely in Shanghai, which meant that the city of Shanghai entered into a lockdown that lasted for 2 months. And that had big economic consequences. So the Shanghai lockdown, it ended in June, and we did see that the coronavirus did stabilize in China in the beginning of summer, but as you can see now lately, the spread of the coronavirus has once more increased in China, and that has led to renewed lockdowns across China, most notably in the capital, in the province of Sichuan in China, Chengdu. It's a mega city with also 21 million people, although that was 2 weeks ago. I read on the news today that this lockdown of Chengdu is eased. But last week, across all of China, 65 million people were affected by lockdowns. And 65 million people, that's more than double the number of people that lives in all Nordic and Baltic countries combined. So we expect that China's zero COVID policy will be in place for a long time, at least for the rest of this year and also well into next year. And one argument for this is that China, of course, has a very large population. So if China were to completely open up, that could potentially mean that very many people would get infected with the virus, and that would cause huge stress on China's healthcare system. And eventually, unfortunately, that might lead to several people dying from the coronavirus. So there's also a huge political consequences of this. But of course, maintaining the zero COVID policy will come at a big economic cost. It limits consumption, it affects production as well, and it also it limits the efficacy of various economic policies. It lowers the effectiveness of monetary policy and of fiscal policy. So during the second quarter, China's economic activity was very weak. Looking at GDP in the graph to the left, it was the weakest GDP since the start of 2020. And GDP decreased by 2.6% in the second quarter compared to the first quarter. Of course, a big effect was because of the pandemic and the lockdowns in Shanghai particularly. And of course, it was expected that China would have a very weak growth in this quarter, but this minus 2.6% number, that was even weaker than what many had expected it to be beforehand. And also, in the graph to the right, we can further see how the pandemic affected economic activity during the second quarter, especially in April and May. So looking at retail sales, for example, that fell on an annual basis by quite a lot. And this just highlights how the pandemic affects consumption. So for one, the zero COVID policy means that people simply cannot go out and consume, as was the case in the Shanghai lockdown. But also, it means that people simply might not want to go out and consume because they fear that if they go to a location where it happens to be that someone was tested positive with the virus, that would also mean that they would have to get tested, potentially put into quarantine, and potentially put into lockdown. And also we see that the industrial production was also very weak, since of course the lockdowns affect the factories as well, since they have to shut down production or run at reduced capacity. So economic activity, we did see an uptick in the beginning of the summer after Shanghai ended its lockdown. But since we since then have these new coronavirus cases in China, that risks putting a dent on the economic recovery. And one way that we can see that the economic recovery is likely to be slow is by looking through some various forward-looking indicators. So here in the graph to the left, we see Chinese consumer confidence. And that has recently plunged to record low levels, of course. An obvious reason for this is the pandemic and zero COVID policy. So this data is an index that goes from 0, where 0 is extreme pessimism, to 200, where 200 is extreme optimism, and 100 is some kind of neutral level. And this is the first time ever that the Chinese consumer confidence is significantly below the 100 line. And as you can also see, the drop has been very rapid and very large. And we also see that consumer confidence in many countries, like Sweden, the rest of Europe, and to some extent in the US as well, is also on record low levels. But in those countries, it's for different reasons. It's because inflation is very high, it's because interest rates are going up. That's the opposite case in China. Inflation is low. Chinese inflation is even below 3%. So of course, the low consumer confidence is because of the coronavirus situation, among other things that I will get into later. And in the graph to the right, we see Purchasing Managers Index, another indicator showing that business sentiment is also quite weak right now. So this is an index that's a value above 50 means that the sector is growing, a value below 50 means that it's contracting compared to the previous month. And we see that Chinese manufacturing sector has contracted for 2 months in a row. The non-manufacturing sector is a bit above the 50 line, but you can clearly see that it's heading downward, and I see that the risks that it continues to go down forward is quite high, considering the obvious effects of the pandemic on the service sector. So these are all these are all effects on China's domestic economy. But during the pandemic, we saw very large global effects as well. And one of the things that we saw during the pandemic was the global supply chain problems, where global supply chains became very strained. We saw very long delivery times. We saw very high shipping costs. And we also saw a shortage of input goods like semiconductors. And one reason for these strained global supply chains, that was because the demand for goods increased very rapidly because there was a rapid economic recovery after the initial downturn during the pandemic. And this increase in demand was so high that supply couldn't keep up with the high increase in demand. But of course, another factor for these global supply chain issues was also the pandemic and lockdowns in many parts of Asia, China, several important ports that had to be locked down. So that had big effects on the supply chains. So in this graph here, we see Chinese shipping costs, and they have been going down recently. We see also in other data that global supply chain issues are easing a bit. Although, as you can see here, we are clearly still far away from how it was before the pandemic. And also, China, or 7 out of the 10 largest ports in the world, 7 of them are located in China. And Shanghai is the busiest port in the world. So I would say that the continued zero-COVID policy in China always risks renewing these global supply chain issues. But these are all kind of temporary effects on the global supply chains that I believe will get better eventually over time. But it might be the case that the pandemic has left permanent effects on the global economy. And one of those effects that we might see that, during the pandemic and during the strained global supply chains, it really brought into light the dependencies on supply chains in countries far, far away from home, and also the complex infrastructure of supply chains. So one effect that we might see from the pandemic on the global world economy is that we might see firms and countries doing more reshoring, moving production lines closer to home. Because global supply chains, or supply chains in general, they thrive on predictability. And with zero COVID policy, that's a big uncertainty that hurts this predictability. So perhaps the pandemic has left a global scar on the world economy in terms of a de-globalization. So leaving the pandemic headwind behind, China is also facing another headwind right now, and that is China's downturn in the property sector. So China's property sector has been a big source for China's growth for the past couple of decades. But in recent years, this growth has been fueled by high amounts of borrowing by Chinese property developers. And in an attempt to limit the borrowing for these property developers, authorities implemented a policy that became known as the 3 red lines policies. So it was aimed at limiting the amount of debt that the property developers were to take on. The problem was that this policy happened very quickly, and at the time of implementing it, many property developers, they already had crossed 1, 2, or even all 3 of these red lines. So essentially that meant that if they crossed all 3 red lines, they couldn't take on any more debt. And for a sector that has been dependent on a high amount of borrowing to fund their projects, this caused a huge credit crunch among these property developers. And we've seen a broad downturn in the Chinese property sector. As developing or property developers are having a hard time finding cash to complete their projects. And this has also led to a deterioration in home buying sentiment, because people they're not sure when or even if the housing that they bought will get delivered. And also this latter part is something that's exacerbated by the COVID-19 policies, because it's hard to go out and buy homes if you can't go outside simply. And here I try to highlight in economic data how some of this downturn in the property sector is affecting the Chinese economy. So in the graph to the left, we see the residential property sector, and we see that the number of building starts, building completions, and the number of floor space sold so far this year, that's much lower than what it was last year. And in the graph to the right, we see the price of new homes and existing homes. And the price of homes in China has dropped for 11 months in a row. And this property sector downturn is quite a big deal for China. According to some estimates, China's real estate sector accounts for as much as 30% of China's GDP. That's a lot higher than in many other countries. So a downturn in China's property sector, that has huge effects on China's economic growth. It also affects global commodity prices. So during the pandemic, we saw that global commodity prices increased quite a lot. That was partly because of these supply chain issues that I mentioned before. And then now most recently, following Russia's invasion of Ukraine, we also saw a very broad increase in the price of many commodities, price of energy, price of oil, price of metal, and also price of food. Recently, however, we have seen a decline in global commodity prices. So for example, last week, the price of a barrel of Brent oil, it dropped below $90 for the first time since February this year. Although now recently, I think it's somewhere around $95. So a reason for this decrease in commodity prices, part of that is because of a global fear of recession. But a big part of that is also because of the slowdown in China. So China is the world's largest consumer of commodities. So an economic slowdown in China, that has huge effects on the price of global commodities. So for example, due to the COVID-0 policy, domestic demand in China is very weak right now. And that's basic economics. If the demand is slow, that means prices go down. And we've seen a slowdown in Chinese imports in the last couple of months. Another factor, of course, as I mentioned, is the property sector. So construction needs many commodities, all the things from metals like steel and iron, but also cement and wood and stuff. So, of course, the downturn in the property sector also spills over on commodity prices. But not all commodities that China imports is used domestically. The majority is used in producing goods that is used for China's manufacturing exports. And it's quite likely that we'll see that the demand for Chinese manufacturing export goods decreases in many developed countries now. And that's because they cut back on spending due to soaring inflation, but also because consumers in those countries, they shift from consuming pandemic-related goods to consuming more services. So with a reduced demand for Chinese manufacturing goods, that will also have a consequence on global commodity prices, meaning that they go down. And the fact that global commodity prices is decreasing, that means that global inflationary pressures are also decreasing. So during the summer, China experienced another headwind for economic growth, and that was extreme weather. So in the northeast of China, there was heavy flooding, but in the majority of China, there was record heat waves and droughts covering central China and southwest of China. And temperatures in the province of Sichuan, for example, reached above 40 degrees Celsius some days and set many temperature records. And so the effects of extreme weather, that affects the economy in several ways. So for example, in China, it affected its energy production. So I mentioned Sichuan as an example. Sichuan has normally access to a lot of water reservoirs and uses a lot of water in producing energy via hydropower. So 80% of Sichuan's energy production comes from hydropower. And it also supplies energy to a lot of nearby provinces as well. But because of these heat waves and because of droughts, water levels were much lower than normally, which meant that the production of hydropower was much lower than what it was normally. And of course, this also comes at a time when the demand for energy is very high, since households and businesses, they want to keep cool in the middle of the heat waves using air conditioning. So essentially this led to electricity rationing in affected cities and provinces. So it had to be rationed between different factories, households, offices, public transport and stuff like this. And that also is something that will have an effect on, for example, global supply chains. So Sichuan is the home of many manufacturing factories. Many big car manufacturers have factories there, for example. So another effect that extreme weather is on the economy is through agricultural products and through food production. So because of the high heats, several crops were damaged really badly, and it's of course not only humans who are affected by the high heat, but also livestock. So for example, chickens, they didn't want to eat as much food as they do normally, which meant that they laid less eggs and so on. And we've already seen through the war in Ukraine that the global supply of much foods, wheat and corn and grains, that's already lower than normal. And because of this extreme weather in China, this might be a potential other factor that puts a stressor on global food supplies. And this shortfall in Chinese autumn harvest of various wheat and grains will have an effect there as well. And also, China is the world's largest importer of food. So the fact that they are facing shortfalls in this harvest could potentially mean that global food prices increases once again. So it's quite interesting. So earlier this year, China set an official growth target. And this target was to have a GDP growth of around 5.5% this year. And despite China employing an accommodative monetary policy and expansionary fiscal policy, it is looking quite unlikely that this growth target of around 5.5% will be met, given the various headwinds China is facing right now. Our forecast is that China's growth will be 4% this year, so considerably lower than their official target of 5.5%. And I would also like to add that I see that risks are unevenly balanced. I see the potentially as growth being even lower than 4% than what I see it being higher than that. So in this graph here, you see these red bars. That's China's official growth target every year. The yellow line, that's China's officially reported GDP growth. And you can see here in this graph that China almost every year reaches its growth target, since the bars are below the yellow line. But it looks like 2022 might be the exception to this, and also by quite a wide margin if our forecast of 4% comes true. I should also say that that recent signals have been some acceptance in not reaching the growth target this year, given the circumstances. But nevertheless, I find this quite interesting. So to conclude, I would like to say that domestic challenges for China's economy have huge effects on the global economy as well. China is the second world's largest economy, and China's GDP accounts for 1/5 of global GDP. So a slowdown in China's growth means a slowdown in the global growth. Yes, thank you for listening.
Thank you, Glenn. But again, that's not so terrible from what I see from your slides. Yes, slower growth, so smaller exports from Germany to China. But at the same time, the slides that you showed, shipping costs have dropped by half compared to the peak last year. Commodity prices, most commodities, even food, of which we have shortage, down by 20%. Isn't that a clear signal that inflation peak globally, with some exceptions, has already been reached? Are we perhaps overly pessimistic?
Yeah, I mean, I would agree, and I think that's something that Matthias pointed out before as well, that the slowdown we see in China causes global deflationary pressures. However, I would still say it's quite dangerous to call peak inflation. We've been calling peak inflation for many months now, and I would say that we still haven't seen that. Maybe in the US we've seen peak inflation, but I don't think we've seen that in the euro area, and not in Sweden.
We have one more question from audience, and you touched upon this, sort of a deglobalization and shortening supply chains, companies moving from China closer to home. Is that somehow going to affect inflation, probably not in the short term, but in the medium term, something that would mean that we will see structurally higher inflation and interest rates, unlike during the last decade?
I would say so, yes. If they move factories out from China, for many years we've been dependent on China for low good prices and stuff like that. So I would say that the most obvious answer is yes. If we move production away from China, closer to home countries, then that would mean higher cost of production, essentially higher cost of consumer goods and higher inflation.
Is that actually taking place, or is this just something that we would like to see? Because surely during the pandemic we have realized our overly high dependence on supply from China. I think the notable example is more than 80% of globally consumed antibiotics are produced in one province. It's Sichuan, I think, in China. You don't want to have such an important medicine being produced in just one small place, which is also not very democratic and not very predictable. So in some cases, yes, but would you see that as a strong trend that we are likely to see this decade, deglobalization and production moving closer to Europe, closer to US?
I don't know if I would use the word strong, but I would definitely say that that's a trend that we will see going forward, more reshoring and more moving production away from other countries, perhaps closer to home. But I think we will still see a lot of globalization in the world economy. We need that. But another example, you mentioned antibiotics, but I think during the pandemic, we saw this shortage of semiconductors. And we've also recently seen that the US, they are setting up semiconductor factories in Texas, I believe. And semiconductors, of course, that's something that's very, very much needed in all technological products. So, yeah, economies, they want to move stuff like this home, so they don't have to rely on countries far away from home for the production of stuff like this.
Thank you, Glenn.